Hey everyone, welcome back to MarketSnap. Target just hit a fresh 52-week high, while the broader retail world is still trying to figure out where the consumer actually stands. Forums are lighting up, momentum traders are piling in, and the stock is up nearly 70% over the past year. But here's the real question we're answering today. Is this rally built on solid fundamentals, or is the market getting ahead of what the numbers actually support? We're plugging TGT into MarketSnap's valuation engine to see if the math backs the move. Let's set the stage. Target is trading right around $170 a share, which puts its market cap at roughly $77 billion. The stock has been on an absolute tear, up about 19% in the last month alone, and over 30% in the past 3 months. But here's the twist that makes this interesting. Over the past 5 years, the stock is actually down about 35%. So we're looking at a massive recent recovery from a period of serious underperformance. The question is whether this momentum has legs or if we're just watching a mean reversion bounce. For those who somehow don't know Target, this is one of the largest general merchandise retailers in the United States. Founded back in 1902 by George Draper Dayton, the company is headquartered in Minneapolis and employs roughly 400,000 people. Target operates over 1,900 stores across the country, selling everything from groceries and clothing to home furnishings and electronics. The company has also built out a robust digital business, and they've been pushing into same-day services like drive-up and order pickup to compete with the convenience that Amazon and Walmart have been hammering them with. The current CEO is Michael Fidelki, who took the helm in 2025, and the company sits in the consumer defensive sector under the discount stores industry. Now let's dig into how Target actually makes its money, because this is where things get interesting. For fiscal 2025, Target pulled in roughly $105 billion in total revenue. Breaking that down by category, food and beverage is the single largest segment at about $24 billion. Beauty and household essentials comes in around $18 billion, followed by hardlines at roughly $16 billion, and home furnishings and decor at about $15.5 billion. Pure beauty products contribute around $13 billion. And there's also an advertising business that's generating close to $1 billion annually now. That ad business is worth watching because it carries much higher margins than selling physical goods. What's notable here is the mix shift. Target has been leaning heavily into beauty and essentials, categories that drive frequent trips and loyal customers. The company just announced the launch of Target Beauty Studio, rolling out in over 600 stores this September, featuring more than 1,600 products from 90 different brands. That's a direct play on capturing higher margin discretionary spending from a consumer that's been cautious. Let's talk about the earnings picture, because this is where the story gets a bit complicated. In the most recent quarter, Target delivered stronger than expected results, and management sounded a cautiously optimistic tone. But when you look at the full year numbers, there's some noise. Fiscal 2026 revenue came in at about $106.5 billion, essentially flat compared to the prior year. Net income was around $4.1 billion, with diluted earnings per share of roughly $8.86. Now here's the thing that jumps out. If you look back at fiscal 2021, Target earned over $14 per share. The company generated nearly $7 billion in net income that year. Since then, earnings have been cut nearly in half. The pandemic-era spending boom flattered the numbers, and the hangover has been real. The company has been dealing with inventory issues, markdown pressure, and a consumer that's been prioritizing essentials over discretionary goods. Looking at the broader financial picture, Target's profitability metrics are actually pretty solid right now. Return on equity is around 27%. That's a strong number for a retailer. Return on invested capital sits near 11%. The gross margin is just under 30%, and the net margin is around 4%. That's typical for the discount retail space. But there are some concerns on the balance sheet. The debt-to-equity ratio is above 1, which is on the higher side for a retailer. The current ratio is below 1, meaning Target's short-term liabilities exceed its short-term assets. That's not unusual for a company with this kind of supply chain and inventory turnover, but it's worth noting. The good news is that free cash flow generation has been solid. The company produced about $4.5 billion in free cash flow in fiscal 2026 and over $7 billion in fiscal 2024. That cash flow supports the dividend, which currently yields around 2.8%. And Target has been consistently paying and growing that dividend for decades. It's a certified dividend king. Now let's break down the SWOT analysis, because this gives us a clean framework for what's working and what's not. Starting with strengths, Target has an incredibly strong brand and a loyal customer base. The company has successfully positioned itself as the place where you can get both groceries and stylish home goods without feeling like you're sacrificing quality. The omni-channel infrastructure is best in class, with drive-up and same-day delivery that rival Amazon's speed. The beauty business is growing, and the advertising segment is a high-margin growth engine. And with a return on equity near 27%, the core business is generating real value for shareholders. On the weaknesses side, the company is heavily dependent on discretionary spending, which is exactly what consumers cut back on when times get tough. The debt load is elevated, and the current ratio below 1 suggests some balance sheet tightness. There's also the question of whether Target's differentiation is durable. A lot of what Target sells can be found at Walmart for less, and the value proposition gets murky when inflation squeezes budgets. Opportunities are actually pretty compelling. The beauty push is a big one. This is a category that's been resilient even in weak consumer environments. The advertising business has massive runway, and there's the potential for international expansion, though that's been a graveyard for many U.S. retailers. Same-day services and digital penetration still have room to grow, and if the consumer environment improves, Target's operating leverage should kick in nicely. And then the threats. Competition from Walmart and Amazon is relentless, and both are investing heavily in their own omni-channel and grocery businesses. There's also the tariff and supply chain risk that can squeeze margins. And we just saw a real-world example of reputational risk. Target stock dropped recently after pulling an offensive Halloween costume amid backlash. In today's hyper-connected world, a single misstep can hit the stock, even if it doesn't change the fundamentals. The company has been through this before with the Pride Collection controversy a few years back, and it shows how quickly these issues can move the stock. Let's look at the price action, because this is where the momentum story really comes alive. Target is currently sitting at a 52-week high, which is a significant technical milestone. The stock is up about 68% over the past year, and the recent acceleration, nearly 20% in the last month, has caught the attention of momentum investors. Analyst estimates have been moving higher, which is typically a bullish signal, and the stock has been gaining ground on solid earnings estimate revisions. But here's the cautionary note. When a stock hits a 52-week high after a period of massive outperformance, the risk-reward dynamic shifts. The easy money has been made. The question is whether the fundamentals can catch up to the price action or whether the stock has gotten ahead of itself. The 5-year chart tells a sobering story. Despite this recent rally, Target is still down about 35% from where it was 5 years ago. This is a recovery, not a breakout to new all-time highs. Now let's get to the part you've been waiting for. What does MarketSnap's valuation model say? Target is actually worth. We ran the numbers through our forward PE model, which is the primary engine here, with a DCF model as the supporting framework. The model confidence is high, and the setup is clean. The inputs are pretty straightforward. We're using a discount rate of 9%, a perpetual growth rate of 2.5%, and a terminal PE of 16, which is in line with Target's historical normalized multiple. We're modeling a 5-year projection period, with free cash flow conversion normalized to 90 to 95% of net income to exclude some anomalous years. We're also assuming share buybacks continue, but at a slower pace, around 1.5% annual reduction in share count. The current stock price is around $130, The MarketSnap fair value estimate comes in at roughly $120 to $125. So the stock is trading slightly above what the model suggests is fair value, maybe 5 to 10% above. The DCF model comes in lower, around $110, while some of the context models suggest higher values. But the blended fair value lands in that low to mid 120 range. So what does this tell us? The model is essentially saying that Target is fairly valued to slightly expensive at current levels. The implied 5-year CAGR is roughly flat to slightly negative, around negative 1%. That means if you buy at today's price, the model suggests you're not getting much upside from capital appreciation over the next 5 years. The dividend yield of around 2.8% would be your primary source of return. What's driving this valuation? 3 main factors. First, growth is decelerating. Revenue has been essentially flat for the past few years, and the model is using consensus estimates that don't project significant acceleration. Second, the terminal PE multiple is being normalized to 16, which is below the current forward multiple of around 18. The model is essentially saying that as growth decelerates, the market should be willing to pay less for each dollar of earnings. And third, free cash flow conversion is being normalized to exclude the anomalous years where inventory swings distorted the picture. Now, I want to stress something important here. These are model estimates, not gospel. The fair value swings dramatically based on your assumptions. If you think Target can return to mid-single-digit revenue growth and maintain margins, the stock could be worth significantly more, maybe north of $150. If you think the consumer stays weak and margins compress further, it could be worth less than $100. The point is, the model gives you a framework, not a prophecy. If you disagree with our inputs, you can plug in your own growth or discount rate assumptions on the intrinsic value calculator at MarketSnap.com. All right, here's my honest take on Target. I think this is a high-quality business trading at a fair price, not a bargain, not a bubble. The recent momentum is real, and there are legitimate reasons for optimism. The beauty business is a genuine growth engine, the advertising segment is a hidden gem, and the omni-channel infrastructure is best in class. Target is a well-run company with a strong brand and a loyal customer base. But I have some concerns. The stock has run up nearly 70% in a year, and the valuation model suggests we're now slightly above fair value. The earnings power of this business is still well below what it was in 2021. We're talking about $8.86 per share versus over $14. That's a massive decline in profitability that hasn't fully recovered, and the consumer environment remains uncertain, with the company itself maintaining a cautious outlook. If you're a long-term investor, here's the math. A $10,000 investment in Target today would be worth roughly $9,500 in 5 years, based on the model's base case, and that includes dividends. That's not a compelling return for the risk you're taking. The upside case is that the consumer recovers faster than expected, and Target returns to its former earnings power, which could push the stock significantly higher. The downside case is that margins stay compressed and the stock grinds sideways. For me, Target is a hold at current levels. It's a quality company, but the easy money has been made. I'd be looking for a pullback closer to $110 or $115 to get a better entry point, or I'd wait to see evidence that earnings growth is actually accelerating before chasing this momentum. What do you think about TGT? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.